All right, folks. Well, listen, welcome to a sunny Wednesday afternoon. Thank you for taking time out of your day to join me for the Q2 2024 commentary. Today, during this session, we will cover off a few areas. Sorry, guys. First one will be I'll actually provide some comments on just the economic recap of what's been happening here to start the year in Q1 and even more recently, the last couple of weeks. We've actually had a lot of data that's actually come out from both the US Fed and the Bank of Canada. I will provide some comments on the market, given some of the global situations that have been happening. And then I will spend time talking about interest rate policy. Will we see a decrease, an increase, or neither? And then I want to spend a little bit of time on how the presidential election could affect equity markets as we move throughout the year and into November. So the first part, again, I always start with a little joke. I have a couple of them today. For those of you that have chatted with me most recently, one of the biggest things I've been talking about is inflation and sticky inflation. It's no different than today. It's still top of mind for a lot of folks and a lot of economists. Heading into this year, we thought there was a handful of risks to the market, to the economy. The biggest one that we felt was going to be the interest rate risk and inflation risk, which are kind of go hand in hand. And then obviously there was the geopolitical risks with what's going on overseas with the wars that we have, and then most recently, obviously we have between Iran and Israel, which has just happened within the last week or so. And again, just the ongoing risk that we see here at home. So, before I jump into kind of the economic data and give you an update, I do believe what's going to really push the markets this year will be how central banks deal with interest rates. And interest rates, like I said, if you go back 6 to 7 months ago, I'll show a couple of headlines, but it was very optimistic about what was going to happen with interest rates this year. But inflation has been very sticky. And as a result, we are definitely getting a more muted game plan from central banks in terms of what's going on with the interest rate environment here. So where are we at currently? So if we look at where we are today, as of this morning, the inflation numbers here, both in US and Canada, which you can see based on the blue and the orange, 2.9 and 3.48, the Canadian is actually within the target range of the Bank of Canada. The Bank of Canada wants inflation to be somewhere between 2 to 3%, likely closer to 2, but they're happy with it being between that. And it's the first time we've seen it in almost over 2 years that it's actually trading or trending in between the 2 to 3%. In the US, a little bit different. We've actually seen an uptick with it more recently. So it's come in at roughly 3.5%. It's still somewhat of a concern, which is the reason why the US Fed is very dovish in their comments about the interest rate moving forward. Now, currently, our interest rate environment is still at 5%. You can see it's been that way for a number of months now. Most recent comments from Bank of Canada is they believe they have a little bit more wiggle room than the US Fed, and they believe that they can actually move on their own accord, meaning they don't have to do what the US Fed does. So if anything, I wouldn't be surprised if we see a Canadian rate cut earlier than a US rate cut. So here are a couple of the headlines. So again, and I've showed this for anybody that's actually attended any of my sessions going back 2 quarters, these were the late 2023 headlines, and it was very optimistic. If you remember, the markets were quite sluggish in October. And then mid-October into November, the US Fed came out and they actually had some pretty positive comments about what they felt the future could look like for interest rates and rate cuts. And at this point, the idea was that we could see anywhere between 4 to 6 rate cuts throughout 2024. And I actually thought that was a little aggressive, but again, there was a lot of optimism, and we started to see the markets pick up shortly thereafter. Now we fast forward just 8 weeks later, and these were January headlines. And in a matter of 8 weeks, it changed from overly optimistic to a little more guarded. Feds will be slow to cut interest rates in 2024. Both here in Canada, same thing. Interest rate forecast for 2024 is overly optimistic. So now we fast forward again about 1 quarter, and here are the headlines as of yesterday. Again, Powell, US Fed signals rate cut delay after run of inflation surprises. I'm going to talk a little bit about that. And then here, our most recent number in Canada, our inflation was a little bit higher, not a lot, but marginally higher in March. So based on our thoughts, we believe that, inflation was going to be sticky, meaning it wasn't going to come down as quickly as what we would have anticipated. And as a result, interest rates were going to be slow to come down. Okay. So here's a good chart that actually gives an idea, if you go back to just, December, October, November, December, about where a lot of analysts felt the interest rate direction would go. And if we look at the left side here, okay, and we go across, you can see here number of rate cuts, around 7, we said 4 to 6, but a lot of optimism, 4 or 5 months ago about how many rate cuts we might see throughout the year, this year. And as time has passed and we've got into the first quarter of the year, you can see the optimism has waned. And we can see a general decline to the point now in April here where we may only see 1 to 2 rate cuts. And I think that's a little bit more in line. And we thought we might have seen maybe 2 to 3, maybe at the end of the third quarter into the fourth quarter. But, I wouldn't be surprised if we maybe only see 2 rate cuts, maybe 50 basis points in general. So again, I think these cuts are going to actually be a lot slower and drawn out unless we start to see a change in just the overall economic outlook. So for you folks that have, debt you're perhaps carrying that you're hoping, we're going to see some rate reductions, we might be waiting just a little bit longer. And for those of you that have mortgages that are renewing, again, we're happy to have conversations with you about maybe what the best strategy is going forward. I do believe in 2 to 3 years, obviously rates will be much more attractive, but here in the short term, I think they're going to continue to hover around that 4.5% to 5% mark that we've seen thus far. So why is our interest rates, why are they slow to come down besides inflation? So a couple things here. So number one, we're seeing a really strong job market. And I'm going to show you both Canada and the US. In Canada, if we look at the job market, this is mid last year, but we can see it's still very strong. Okay, over the last 7, 8 years, we can see that the unemployment rate is still at one of the lowest periods that we've seen in the last 7 years. Here's obviously in COVID, but in general, we haven't really seen an increase in unemployment rate, despite the fact we're in a high inflationary period. The second thing for Canada is that we have really strong wage growth. And so what's interesting is when we actually look at total CPI and then CPI excluding food and energy, it's this green and blue lines. You can see them right here. Okay. And so what's actually interesting, you can see that these have come down gradually since peaking in 2022. But what's interesting is the hourly wages of permanent employees, they've actually increased and now they're outpacing your CPI. And why that's relevant, it means there's more money in the economy, which again props up prices, and again, it doesn't allow inflation to come down. Now, in the US, it's a very similar story. In the US, when we actually look at the estimated job markets, the unemployment rates, unemployment has been below 4% for 26 straight months, okay? And when we look at payroll, and we look at actually the numbers that have come in over the last couple years, and we compare that to the estimates that the analysts felt, every one of these bars here that it's above zero, this is a greater amount of jobs than what they would have forecasted. So if you actually go back over all these various periods, we've had some significant surprises on the upside for job creation rather than job loss. And so just like Canada, we have a very strong job market in the US. And so again, there's more money in individuals' pockets, and therefore there's more money in the economy. Another thing that was really interesting that somebody mentioned to me today, an article just came out, was that what we're finding as well is because short-term accounts, cash accounts, because they're paying more in terms of interest income, for a lot of folks, it's money found. It's money that's actually accumulating in their bank accounts. So what they're doing is instead of reinvesting it, they're actually taking that money and they're actually spending it in the economy. Yet again, boosting the economy in just the terms of supply and demand. So again, it's an interesting period of time until we actually see some of these job losses either plateau or job creation plateau. I think this is one thing that the central banks will continue to keep their eye on in addition to inflation. And the last piece that I think that is important when we talk about geopolitical tension, we're seeing conflict here in the Red Sea. Okay, and why that's relevant is this is a big shipping lane, a lot of cargo flows through the Red Sea, and so what's happening is instead of um, cargo ships going the shortest way around, in terms of delivery, they're actually taking the long way around. So what generally used to take 25 and a half days, okay, are now taking almost 50% longer, 34 days. Some of these deliveries are taking. So we're seeing a lot of cargo ships actually take the long route. The problem with that is it just increases the time to get supply into the economy. Therefore, the demand goes up, and again, this can trickle down into the cost, the inflation numbers. This additional time and travel during this period, they're not doing it for free. It's going to trickle down into the cost of goods somewhere. So that's a concern. That could trickle down into the economy and again keep inflation high, and therefore slow the rate cuts that we would anticipate to happen late this year. So again, these are all the things that I think are some headwinds in terms of this interest rate policy. So let's switch gears from the economic piece, from the interest rates, from the job growth and so on. Let's talk a little bit about markets and what's happening with the markets. So the biggest thing, we obviously hear, again, I came across this, I thought this was great. We obviously are familiar with bull markets and bear markets. What's really interesting with the markets today is there's no real rhyme or reason. The S&P 500 has really strong earnings, so we anticipate things to remain strong. But I believe, we've had such a great run since late last year to now. It's no surprise if we go back or we go through a period of contraction. Okay, it's just a natural evolution of the markets. So what's happened thus far is we had a really good start to the year, starting in January. These track all the major North American and global markets, notwithstanding the bond markets. So we've had good growth up to April. And then with some additional geopolitical tension, with the uncertainty on interest rates, which actually slows the economy, affects corporate earnings and so on, we've actually seen a correction. And when I say correction, I use that loosely because generally speaking, a correction is defined by a 10% decline on the markets from its peak. So when I say correction, we've had a pullback. It's probably a better word to use. So we've actually seen a decline in some of these major markets anywhere between 3 to 4%. So, the NASDAQ and the S&P 500, which, peaked at roughly 10% for the year, are now down between 6%. The Dow Jones is actually only squeaked out a gain at 0.4. And our Canadian market here has come in at about 3.5%. So we're definitely going through a period of time right now where we're seeing a little bit of contraction in the market, which we anticipated, just given this run of growth that we've seen over the last 4 to 5 months. Now, from a feeling, from a fear point of view, and I've talked about this a lot in 2022, not so much in 2023 because we saw a general trend upwards in the markets. Biggest thing what we're seeing right now is, this is a meter essentially that CNN puts out, and they look at about 7 different items that goes into this measurement. And what we can actually look at, we can see, the overall investor sentiment. A year ago, they would consider it greed. It would have fallen into here. Okay. And in some periods, we've had extreme greed, but in general, a year ago was greed. A month ago, so 1 month ago, would have also been the overall sentiment would be greed. Okay. But what's happened in the last 2 weeks, the overall sentiment based on a number of those different factors has actually dropped down in the fear piece. And it's not a surprise. Like I said, I don't show this to worry individuals, but just to show that, hey, we go through periods of ups and downs. So in October, we were in a very similar period of time where we actually had extreme fear within this measurement. And then, as I mentioned before, here's where our extreme greed was. We've had it for a long period of time. And here in the very short period, in the last 2 weeks, we've actually seen it come down again. So this is just the investor psyche that I think we need to be aware of. Okay, because what happens is we design portfolios not for short-term periods like this or like this, but rather over time. And we recognize that as we invest, we're going to have periods of ups and downs, but over time, it's going to go up. And I'm going to show you a graph on that in a second. So the volatility index, here's again, to put it in perspective, folks, this goes back, this is a 10-year graph I pulled off. Here's the great financial crisis. Okay, it's actually a 20-year graph. I apologize. But you can see the volatility index, the index that measures volatility in the market. In 2008 and 9, it peaked. Most of us on this call, we lived it. Okay, it was stressful. All right, we had big swings in the market. Overall, there was a lot of uncertainty. But as we moved out of 2008 and 2009, the volatility index, you can see actually plateaued, and we had periods of ups and downs. Here's COVID, another big one. And then overall, since then, we've generally seen it decline. So although I said the volatility index is up, again, we put it in perspective. Here's where it is right now. And I've circled it here in the red. Here's where it's been over time. So again, in perspective to what we've seen over the last 20 years, or even over the last 5 years, the volatility index is still quite low. And this is what I mentioned earlier about the graph, folks. So I think this is important to go back again. I talked a lot about this in 2022. Here's the market. This is the S&P 500. This is the total return. This goes back again just after the financial crisis starting in March of 2009. And over this period of time, it's been roughly 15 years or so. We can see there's been a lot of significant events that have happened over the last 15 years. Okay, we've had COVID, we've had recessions, we've had different elections, US elections. And the common theme with this is despite these, all these moments of time where we've had uncertainty in the markets, overall in general, markets have trended up. So when we do go through these periods where we get some uncertainty, like we're seeing right now, we need to go back and say, hey, we might feel a little bit nervous today because we have recency bias. But if we go back even as much as 12 months ago, 18 months ago, again, we didn't feel this way because the trend was upwards. And so for us as investors, me included, for us to experience growth over the long run, we got to stomach some of these ups and downs. And I believe, we will get ahead of it. Obviously inflation will finally become more under control and predictable. And the central banks will have no choice but to start to cut interest rates. And they are anticipating to do it this year. So it's not like they're not going to do it based on their current comments, but rather it's just going to be a little bit slower than expected. Okay. The second thing is the geopolitical risk. These will, I believe, sort itself out. We've unfortunately been dealing with uncertainty overseas with 2 different wars for now, going back almost 2 years. Overall, the markets have, I think, priced a lot of that in, notwithstanding the most recent one. But a lot of these don't generally affect the market as much anymore. The markets really move when there's uncertainty in the global outlook. And right now, obviously, the tension between Israel and Iran with what's happened in the last week creates uncertainty. Interest rates create uncertainty. And therefore, we see, a pullback, a recent pullback, which again is just some of the profits that we've had over the last 6 months. So we will have other profits in the future. But again, we're just going through a period, this little hiccup as we work through this period of time here in 2024. All right, so let's switch gears. We're going to talk a little bit about the presidential election. And by the way, I am getting some questions. Feel free to type any questions in the question and answer, the Q&A. And I'll do my best to answer them before we jump off the call today. And if not, I'll just send you guys emails thereafter. So presidential election, I'm starting to get some comments. This has kind of been back burner. A lot of folks haven't been asking questions, but over the last couple of weeks, I've been getting a lot more about how the U.S. presidential election, how it may impact markets. Okay. So I think the biggest thing is we all recognize, almost everybody I speak with, the 2 candidates that we have in the U.S. to run the country for the next 4 years, they're not great. And I often joke, I say, hey, we 300 plus million people in the U.S., and these are the 2 best candidates they've been able to come up with over the last 4 years. So regardless of which side of the fence you sit on, whether you're pro-Democrat, pro-Republican, I think there's a couple of benefits with the 2 candidates that we do have today. I know it's kind of ironic to say that. But I believe, the fact that Biden's put in 4 years, Trump has also been around, obviously, the previous term for 4 years. I think that's a benefit for the markets because we have an idea how both of them run the country. We have an idea of what their policies are. And the benefit, again, I talked a few minutes ago about uncertainty in the markets. Those are 2 things we know. When you have a new president come in that has no track record, that creates uncertainty within the markets. In this case, regardless of how you feel about the candidates, we do have an idea of how their policies are going to probably work out over this next 4-year period. So a couple of charts here. So this goes back here almost 100 years, 90 plus years on the S&P 500. I use the S&P 500, largest market in the world. When we actually look at volatility as we get closer to an election, what's interesting is when we look out 1 year prior to the election, we can see a couple different volatility depending if the incumbent party won or lost. But regardless, we can see that volatility tends to trickle upwards before the election. Here's where the election happens. So 1 month prior, we can see again, volatility tends to peak. And then post-election, we tend to see it, fall downwards. So during this period of time, again, uncertainty, we tend to just see, markets ratchet up a little bit as the decision is coming out. Well, when we look at performance, the performance is the same. So what we see here, performance 1 year prior is pretty strong. But as we get closer to the election, 1 month prior, a day after, 1 month after, we actually see the markets are fairly flat, generally speaking. But then when we get out 3, 6, 9 months thereafter, we start to see things pick up. And again, it goes back to the uncertainty or now knowing specifically about who's going to run the country and what their policies are. So I would anticipate in general that we might see some increased volatility as we approach the election. We might see the markets tend to stable off a little bit, which makes sense because we're going through the summer months. And then I think we're going to see generally an upside or an upswing as we get into the latter part of the year and into next year as well. That's what my thought would be. And then when we look at just in general, what happens with the S&P 500, regardless if a Democrat or Republican wins, this is a good snapshot, again, to put things in perspective. Regardless of who runs the country, George Bush, he was one that didn't have a great, run from a market perspective. But in general, markets trend upwards over time, regardless of who's running the country. Okay. At the end of the day, there's a lot of fiscal and monetary policy that's going to go into earnings with companies. You might argue that some of the companies are overvalued right now. You'll see some people that'll say there's a little bit of opportunity with companies. I tend to be on the latter. I think they've had a tremendous run here in the last 18 months, and they are taking a breather. But I believe there are some that are still somewhat undervalued that pay really attractive dividends right now that are tax preferred. I'll talk about that in 1 second. But again, when we look at the presidential election and how it'll affect the markets in general, even though, again, in the short period of time, we might get uncertainty, over the long run, I think we'll see it trend up. And then I mentioned I would circle back here with some of these companies, and I mentioned this on my last session, but we've seen a significant amount of growth with respect to growth companies in the last number of years. And what I mean by that is if we look at the Mega 7, we talk about the Magnificent 7, the Mega 7, companies like NVIDIA and Meta, or which was the old Facebook, Netflix, Tesla, Amazon, Apple, and so on. These companies have had significant growth, which has really driven the market. The NASDAQ market is now 50% made up of just those top 7 companies. S&P 500 is almost a third. So as we've headed into this year, what we found is that all 7 aren't doing as well. Okay, there's a handful of those 7 that are doing well, but in large part, 4 or 5 of them are actually very sluggish this year and actually are trading in negative territory. So what we're seeing is a much more broad market rally or growth outside of just those tech type companies. And when we look at where we're at between value and growth as we head into the next chapter of the market, generally speaking, after an election, your value companies, which have largely been have underperformed growth stocks, tend to do a little bit better. And I recall doing a session before the last election where we talked about this as well, and we saw growth in the value space more than we saw in the growth space at the time. Okay. Now, one of the things I mentioned that I wanted to comment on, right now we're in an interesting period of time when it comes to interest rates because they're still elevated. So right now you can probably get a GIC or a high interest savings account somewhere between 4.5% to 5%. Maybe a little bit more, but in general, you can get that, even though inflation is now trending around 3%. I believe obviously that's going to trend down. The problem with interest income is that it's 100% taxable. So for some of you folks that are filing this year that have moved money into an interest-bearing investment, a GIC or a high interest savings account, you will likely pay more tax this year. because you don't pay tax along the way, but when you file, you got to pay tax on that income. Well, I think what's going to happen is we're going to see people rotate from a GIC earning 4.5 to 5, and they're going to say, hey, instead of owning a GIC through TD Bank or Royal Bank or whatever, why don't I own the stock that has capital appreciation that has been sluggish and pays me a dividend between 4 to 6%? Okay. Dividend income, just so you're aware, dividend income is taxed at a lower rate than interest income. So as they cut rates, GICs, interest-bearing investments are going to go down. And right now we have a situation where dividends are actually paying between 4 to 6% tax preferred, which means you're keeping more in your pocket. Plus you have the potential for capital appreciation. So for those of you that have some cash on the sidelines, or you have cash in GICs or what have you, it may not make sense for everybody, but it perhaps makes sense to start talking about it because, again, some of these opportunities are pretty attractive right now. Okay. So again, I do believe value will start to outpace growth. We've had a significant run. And if anything, we may see people start rotating some of their portfolio, from those high growth stocks, locking in some of their profits, repositioning to things that are just undervalued at the moment. Okay, I'm gonna just follow up with the last two slides, folks. I don't know if anybody saw. It's not the worst kept secret, but it came out yesterday. They announced the new budget. For those of you that haven't seen it, I hope this isn't going to be too much of a shocker, but I did want to talk about the capital gain inclusion rate that is changing. This is something that they've talked about for years. Okay. Now, for some of you that's hearing this firsthand, you might be panicking a little bit. It's not as bad as it looks, but it's things that we need to be aware of. So the change here, the biggest change on the new capital gains tax. So first off, the new rule will apply as of June 25th, 2024. Okay. This is going to lead to some proactive planning on our part, along with some of our clients, not everybody, but for some folks that have big capital gains. So what will happen is individuals, you and I, will continue to only pay tax on 50% of the capital gain up to $250,000 a year. So let me take a step back. The current rule is any capital gain you receive, only half of it is taxed. The other 50% is not taxed. What they're proposing is up to $250,000, nothing changes. Where the change occurs is anything above $250,000. Above that amount, they're going to now do 2/3, 1/3 for the capital gain, meaning 2/3 of that amount will be taxed and only 1/3 of it will be non-taxed. Okay. And I'm going to show an example in 1 second. Now that's on the personal side. And for some of you that are sitting there, you might be saying, it doesn't affect me because I'm never going to trigger $250,000 in the year. Well, if you have a second property, a rental property, or what have you, this will affect you. Because for a lot of folks in Vancouver that have held properties, a second property, not a principal residence, a second property in their family for years, now we're going to be subject to a 2/3, 1/3 split on any gain over $250,000. So that's number one. Number two, this inclusion rate for corporations and trusts from the very first dollar of capital gains will be a 2/3, 1/3 split. So let me just say that one more time. Personally, up to 250 is 50-50. Then it goes to the increased amount. Corporations and trusts, the very first dollar of capital gains you receive after June 25th, 2024 will be taxed 2/3 with the remaining 1/3 the tax-free amount. Okay. That can be significant for folks that have large unrealized capital gains, whether in a corporation or a trust, or even if you happen to be owning a second property personally. Okay. So let's look at an example. So, and I worked the numbers with my team yesterday. Okay. So again, this is an example. If an Ontario resident has a $400,000 salary with capital gains of $300,000, okay, and they've used this $400,000 just for the tax rate, folks, okay, to make it a little simpler. So this is how the tax changes affects capital gains. So in the current year, okay, up to June 20th, in the current year, if you had a $300,000 or last year, $150,000 would be the capital gains that you'd keep in your pocket. The other $150,000 would be capital gains tax at whatever your marginal tax rate is. Now, under the new one, okay, and again, you might think, well, how are you getting these numbers? So on the first 250,000 of the gain on 300,000, it's going to be taxed 50-50. So 125,000 is going to be taxed at your marginal tax rate. The other 125,000 is going to be no tax. You're going to keep it in your pocket. But the additional 50,000 is going to be split 2/3, 1/3. And that's how if you add the 2/3, 1/3 to the 125, now you're actually paying tax on 158,300. And you're only keeping in your pocket 141,700. So it doesn't seem like a significant difference, but it does add up, folks. So again, it's on the amount above 250. This is personally, by the way. In a corporation, does not apply. It would just be 2/3, 1/3 on the whole capital gain amount. Okay. So if you have questions about the budget, there was a few other things that came out of it. This is probably the biggest one. They are making a couple changes to the home buyer plan. So if you have kids or grandkids that are going to access an RRSP for the purpose of a home purchase, they now can actually access almost twice the amount out of it, which is fantastic. They also have the first time home buyers plan, which is or home buyers account, which is helpful as well. So what the government is trying to do is they're trying to make homes more accessible. And folks, today, it's actually more expensive to own a home than it is to rent, believe it or not. Even though rental costs today are probably between $3,000 to $4,000 a month. And that's not a joke. I have folks on my staff that are paying between $2,500 to $3,500 for single bedroom apartments in Vancouver. That is the going rate. And the problem is that we have such an aggressive immigration policy here in Canada. We have more people coming in than what they're building. And so it's keeping that demand high. So again, this is one of the benefits of, multifamily residential properties, which a lot of folks on this call, they own through the Foresight real estate portfolio. But this is the reason why they're so attractive right now. Okay. It's really costly to actually buy a home in Vancouver or across the country, given the elevated rates to actually get a mortgage. So the rental income is actually still quite high. Okay. So I'm going to pause there. That was the last slide I had, but I'm getting quite a few questions that are coming in. So bear with me. I'm going to answer a couple of questions. So here's something I had something. Is it worth selling corporate rental real estate before June? It's possible. Again, it's difficult to advise on that without knowing your situation. But I think we are going to see more folks list their properties perhaps in the next 2 to 3 months. Especially if they have a big capital gain on it, just given the fact that you could lose a significant portion to tax. So I think that June 25th deadline is going to motivate a lot of people whether they're going to keep it or sell it. The second thing on the real estate is if you happen to have a loan or a mortgage against it, your renewal rate is going up to the point where your actual profit, if you are keeping profit from the rental income, it's getting squeezed. So now for a lot of rental or second properties, they're actually having to feed that property out of their own pocket because they're not making enough money to carry it any longer. And we're seeing that quite often. Okay. And then I had another question here. I'm not quite sure about it. Where's our dollar going? 50 cents. I'd have to maybe circle back with the individual that asked that question. I don't quite get that one. So again, I'll circle back with the individual that wrote that one. I do have another one. Somebody asked about real estate markets. And again, what do we see as the growth outlook? I saw actually had somebody send me an article. Thank you if you're on the phone recently after my last session. If you look at the Canadian Real Estate Board, they feel prices will continue to move up just simply because of supply and demand. Despite the elevated mortgage rates, we just don't have the demand. We have more people coming into this country than we do have building permits out there. And that's one of the surprises. I anticipated real estate to maybe soften a little bit as rates kind of peaked here in the last couple of years, but we just haven't seen it. And as a matter of fact, we see homes that are sitting on the market longer, but we're not seeing significant discounts on those homes yet. And again, part of that is I just think things are taking longer to sell, but there's just not enough inventory to compete against each other. And plus, if you remember from one of my other sessions, I talked about this in the Lower Mainland, 50% of the homes in the greater Vancouver area, they do not have a mortgage. So increasing interest rates don't really have an impact on those individuals, so they're not motivated to sell. But there's other 50% that are going to have to renew, at least some of them. I believe they'll do everything they can to maintain their home in the short term until interest rates come down. So I don't see a lot of inventory coming onto the market, but we might see a little bit of an uptick with the most recent budget news. So we'll see what happens there. So, oh, and then I had another question about, and I mentioned this earlier about investing cash. If we have cash, what should we do with it? Again, I still think I wouldn't invest in a GIC. GICs, you might be able to get, roughly 5%, as I mentioned before. If you are looking for GICs, let us know, because we shop the market. We don't have GICs here at Harbourfront, but we just broker it. So what that means is we go out and we look at all the different GIC rates we have available, whether it's through BMO, RBC, Coast Capital, Laurentian, or what have you. And we get a list, and then we, based on their suitability and stability, we'll make some suggestions. But I think, on a 1 year, you might get somewhere between 4.8 to 5. But again, we're getting a pullback in the market. There's an opportunity here to, get a few things on sale that we didn't have, 6 weeks ago. And then plus, like I said, with the dividends, yields right now, given where some of these value tech companies are traded, I think are pretty attractive. Again, you can get anywhere between 4.5 to 6% in some really good companies that I believe over the next 2 to 5 years, if not even shorter, you'll see actual capital appreciation, and as well, you'll get a nice little quarterly check that comes into the account every quarter. So, all right. So I'm going to wrap there, guys. Again, today I actually made it a little bit shorter on purpose. I didn't want to keep everybody from this beautiful weather. We did a session actually a couple of weeks ago where we covered some of this as well. So if any of you have questions, please feel free to email me, or you can call me or my team. I think everybody in my numbers is on there. Our team number is on there. Once again, I appreciate everybody joining us on this beautiful day. I wish everybody the best. Enjoy the rest of the day and the week. And once again, thank you for joining us today. All the best, and we'll talk with you soon. Take care. Bye now.